Welcome back to the Market Insight Call, joined as always by Aaron Tuttle. Got a lot to get through. We had plans to cover in this what we got right, what we got wrong in the year to date so far in the first half of 2025. There are some things we have to cover instead of that we will start with. Before getting there, I did just want to cover listening to Josh Brown on a podcast last night. Frequent talking head on CNBC. Has a great job of tracking emotions in the market. Doesn't dive into data like we do. Tracks it based off feel. He's actually pretty good at that. And what he's seeing at CNBC, all the talking heads, when they start talking about the Strait of Hormuz, he starts calling this his indicator. Generally, it's a buy signal. When you start having traders as their day job looking at markets, now talking about the Strait of Hormuz, time to start saying, maybe this is a little overdone.
And so you don't have to watch CNBC. You can have Chris curate your talking points and understand what Josh Brown is saying. Make sure you hit that subscribe and let your friends get that information too. Hit that share button and pass it over. Thanks for joining us.
Because it is a true idea that there's panic in the market when someone that doesn't know what they're talking about, they do some research online to talk about the straits. Not something we're going to be doing. But let's look back at market pullbacks, specifically in the last little over a year when Iran and Israel were exchanging airstrikes last time. And what we saw in the markets was a 6-day sell-off in a row, pretty well contained actually. That's similar to the market we see now, which is there hasn't been deep panic from the sell-off or from the war yet. And it was a 4.5% pullback. So far, as of this morning, it's been 1%. So the market's a little desensitized to it. Potentially there are some other things we've been talking about. I know Sunday night I was messaging you, trying to play this whole thing through. What does Russia do? What does China do? And your response was, market just wants to be strong here, wants to keep going up.
Right. Back to the emotions component, that you can feel that the market is just brushing this off when you see market movement like this off of news that really should have a pullback, and it doesn't. You know that the emotions there are the market wants to move up.
Mm-hmm. And let's talk about those reasons why and what a normal pullback would look like. We already said if this were the same as last time, it'd be about a 4.5% pullback, and we've only seen a third of that so far. In a normal uptrend of the market, we've drawn in all of our lines. These are just the typical charts we always use. Red is a down day, green's an up day. And we did our retracement lines. And you start to see we barely off the highs of the year. And what a normal pullback would be, 3%. It's just a normal pullback back to the 200-day moving average. 5.5%, also extremely normal pullback to a Fibonacci retracement. We don't need to go into what that is, but it is a common pullback. And right around there is the 50-day moving average, which is moving up. Tend to find a lot of support here. So if we're staying in that range, we go back to what you said, still a really strong market.
And looking here, I see the 50-day is approaching the 200, and we have that resistance level. My guess is once that 50-day goes to the 200, that market moves up, because it definitely, there's far more buyers that are just wanting to get in, and then you have the short squeezes from covering at this point.
And what is primarily going to drive the market is the impacts from the oil market. And this is what we can see. We'll throw up a 5-year chart of this. We've had a strong bull market the last 2.5 years in the stock market, but let's look at what oil's done over that time. Going back to 2021, that's coming out of COVID, really low oil prices for obvious reasons. We get a spike with the reopening, and then a continuation spike where we went above that red line with Russia-Ukraine war. And then we start to enter the bull market that we're in now in equities, and we can see that the range in oil was in that high 60s to 90. And that 90 and spikes towards then were all off Middle East spikes. October 7th of 2023, and then the other thing that I mentioned in April of 2024, we get those spikes. Well, we started this one well below that range, in the 50s and 60s on oil. Now we're in the mid 70s. Could go up to 80 pretty easily and still be well contained with what we've seen on normal oil prices within this range.
You know, oil just doesn't give me the anxiety that it used to. Go a decade or so more back, because one, the U.S. is no longer dependent, and if that price does move up, there's a lot of supply that just comes on. Because now all of a sudden those higher cost producers, the U.S., all of a sudden can make profits, so those wells kick back on. So I think there's a natural limit to where price of oil can go, unlike it was prior to 2008, where we had peak oil fears. We're just not operating in that environment. That's not to say that oil isn't an important component to the economy. It certainly is, but it doesn't seem to drive as much as it used to. And we can see this in the chart on the U.S. supply, but also the fact that if prices go up, new supply comes on. So high prices solve high prices.
It's a theme you've talked about for a decade, high prices solving high prices. And going back to where prices were under 70, not a whole lot of U.S. suppliers make much money. That's near their break-even cost. So getting back above 70 is probably actually healthy for them and more in line with what we've seen. And I love the way you put it. It's our theme is, and we started this when we started talking tariffs a few months ago. We're not the firm that's going to come out and say, you put this tariff, it has this exact impact. The market looks at those, and I wanted to pull a slide of what they're saying. And this is the impact based on a model from the Fed, goes back a long time, of a $10 price increase in oil, because it's what we've seen. GDP is lower by 0.4%. Again, I'm skeptical of that number for a lot of the reasons you said with the model. The second part is an easier flow through. Oil finds its way into the inflation metrics, the CPI. It's a lot easier to track that way. And that tends to be a 0.2% higher off that move. The flow-through impacts of that, because the rest of it, oil impacts the rest of the index as well, tends to be about 0.15. Skeptical of that too, because that can have different impacts as well. But directionally, which is our goal here, saying it's not great when oil prices spike. So that's really the concern. We want to make sure we're staying away from that 90 price oil. Staying in the middle of that range, I'm not concerned.
You know, one of the things that we said early on being different than most of the other commentaries was that these tariffs, you mentioned tariffs and inflation here, would not show up in the CPI in a sizable way, right? Because inflation is always and everywhere a monetary phenomena, and if the Fed is not expanding the balance sheet, we're not going to see that show up in the CPI. There would be a lower standard of living. We're not saying that tariffs are good, but I think this is that one component that can actually start to challenge that call. So we've been right so far. CPI has not taken off, and most of the market had anticipated that it would show up. But this is, if we do see the Middle East issues going up, especially if the U.S. Gets involved or the big beautiful bill goes and we really do have significant deficits, those would actually challenge that call, where we'd actually start to see CPI move up, because ultimately we got an expansion plus the way that the oil hits that index on pricing.
I think it delays the call. It pushes it out. It try to see, is this a spike? Is it a new change in the model? Are we going to start staying at the upper end of that band in the high 80s? Do we come back down to 75? If so, we're right back on with what our call was. And if we bring back in what we were saying about the Fed meeting today, they have been pretty hawkish because of tariffs. They're afraid tariffs are going to increase costs. They disagree with us. And we've been right on that. I think this increase in oil is just going to meet them to where they were.
Yes.
Exactly what we just described. They know that's going to increase it. And it's just going to bring it to where they thought they were. And once we can move past it, we can get back to some of these
the other place, because there is so much consensus that inflation would go up, and I'm going to take the victory lap. So far, we've been right. Is we see that in the dollar index, right? The dollar index has been selling off, despite the fact that if you look at rates on U.S. paper versus other countries' paper, you actually would think that there would be dollar strength. Well, why is it? It's because everyone's anticipating that after you take inflation out of what you're earning in U.S. paper, it's actually below that. So if inflation isn't showing up and we continue to go through this, then I'm starting to like the dollar because inflation is getting incorrectly priced into the rates.
Yeah, let's show that. You know, we got a great call on inflation. We had a good call on U.S. large cap stocks for the year. What we missed was the dollar and its impacts on foreign markets. The dollar's down nearly 10% on the year, depending on where you mark it down. That flows through to a U.S. investor as basically a 10% increase in our international stocks. So international stocks could be up 15% this year because they're up 5% on their own, and then they have that currency impact. That was something that we did not predict heading into the year. We thought the dollar would be pretty stable. So it would really not have that big impact. And so now we try to look at where do we go from here based on that incorrect call. We can look at 2017, 2018 as a comparison. 2017, similar. The full year had the decline we've already seen with the first part of this half of 2025, and a lot of the same issues, right? Afraid of the administration, political risk, the idea that there'd be broadening growth internationally. You show up to 2018, the year later, there wasn't really broadening growth, and you had that large interest rate differential that you just described, which is the long-term driver of currency. If U.S. interest rates are higher, people are going to want to come here and invest in that real interest rate. And what you described is right here on this chart. We have the Hong Kong, which can be ignored because it's pegged to the dollar, but U.S. rates significantly higher than everyone else because they've been cutting and we've been holding flat. So I think what you just said, it's going to be a great tailwind for the dollar the next year. We're still adding international stocks because we have made, in case this is not correct, right? We've been wrong on that call, but I still think this will become a tailwind.
Well, on the fundamentals on the U.S. market, you look at demographics, you look at capital allocation, there's a lot that is going in favor of the U.S. that you just don't see in the Eurozone, energy being one of them. If the U.S. is energy independent or can be at higher prices, and everyone else is struggling because of their energy policy, energy is a huge component into industrial manufacturing, chemicals, et cetera. All of a sudden, the U.S. looks like a favorable place. In addition, we saw that negative GDP. A lot of that was the front running of imports, bringing those in. I actually think we're going to start to see the tailwind of that as that inventory starts to get built into the production and we don't have as much imports coming in. So I think the later part of the year, absent inflation showing up in the CPI, the U.S. is actually the place you want to be. And we think that is the case long term anyways.
Mm-hmm. And what you described too is strong GDP. The model we use is trending at 4. It's above trend for reasons you described. It will start coming down. But we start to say, we look at that model, let's take it for what it said, 0.4 decrease in GDP. Start to see an impact here. It's pretty small. The market can easily handle that, especially if it's short term. Final call of the year to cover would be the big sell-off that happened. Not really predictable, but we predicted in early April that we'd see a really strong recovery. We called it a swoosh-shaped recovery, the bottom right here, showing that it would level off. It's exactly what we've seen, but it would be very similar to a V with a really aggressive move. We said we didn't think we'd see new highs that easily. We're getting pretty close to that. Do we think we want to start making a change in that call?
I think a lot of it comes back to what's the situation with the U.S. On whether they want to participate in this war or not. I know that we were talking about a technical chart that we saw where you had the pennant wedge, where the U.S. joins the war, U.S. doesn't. Even if it does join the war, you have downward pressure. I think we agreed with it. There was more of a jest on social media. But the U.S. joins the war, yes, there's a drop, and then it's going to continue to move up because it's going to be a lot of spending, a lot of inflationary component that's built in, and the index will then move up. So either way, I think the trend of the market is yes, it's going to take a little bit of time to hit new highs. Once we do, we're going to continue to move up.
And just to cover the tail end of joining a war for several years, which the market is used to, it does happen. The data in the book that we subscribe to, Stocks for the Long Run with Jeremy Seigel and Schwartz comes on our podcast once a year, is the data they show is returns in wartime versus peacetime are identical. You get the same nominal return. You mentioned the big component is inflation.
Yes.
Inflation's higher in wartime. So the real return that you feel is lower in wartime, but the number you see is tending to be the same. So to close out what we think of getting back to all-time highs, really to say, we were right on the swoosh call, but now we have new information. We're getting closer to maybe we do get to new highs. I think the new information is we haven't closed out tariffs. We don't know where that is. That's going to put strain on the Fed too. They are not going to be happy sitting here 2 months after the last time they released their projections and they don't know where tariffs are going. They're probably lower than where they thought they were at the time, but they still can't put a number on it. So they're going to be, at least right now, hesitant to cut rates. They're not cutting rates today, but just in their forecast. So we still have to get past tariffs. You already mentioned the big, beautiful bill. We don't know what the Senate's going to do with that. They released it on Monday with their first draft of it. And then we have deregulation, complete second half story. The new story actually last night is starting to work on leverage ratios at the banks, trying to get treasuries, trying to get capital freed up. Maybe it'll bring down treasury rates, which can work its way into lower rates through the economy. So if that starts to happen, and we start seeing that, and earnings came in much stronger than we anticipated when we called our swoosh shaped, and we start seeing the next earnings season, we could easily switch our call to saying all-time highs are going to be much closer.
Yeah, I think the market will just climb the wall of worry going forward, with the possibility of a nice downward draft if the U.S. does engage in Iran, but then it'll continue to pass through and climb that wall of worry again.
I completely agree. We'll come back next month where I'll make the call now. I think we'll be closer, even though we keep kicking out tariffs, kicking them out 90 days, we'll be closer to showing a chart of where we think those tariffs are going, and we'll revisit what we've talked about on tariffs. We will have much more data on the bill, and we'll focus on those, and we'll focus on deregulation next month. So see you then.